In the world of forex trading, there is a name mentioned as a symbol of simplicity and realism: Bob Volman. He is not a flashy trader, nor someone who makes empty promises about unbeatable win rates or unrealistic profits. On the contrary, he represents the core truths of trading: understanding price action, managing risk with discipline, and keeping patience when most people lose it. If you have grown tired of complicated systems, cluttered indicators, or strategies filled with theoretical jargon, Bob Volman's method will feel like a breath of fresh air. He shows you that all you really need to succeed in the markets is remarkably simple: a clean chart, a few straightforward principles of price behavior, and a calm mind that knows when to stay out. You will not find magic formulas in this method, no fancy patterns, and certainly no technical indicators that turn your screen into a colorful maze. Instead, Bob Volman teaches you to observe each candlestick, each small shift in price, every sudden little shake the market produces, so you can understand the true psychology of the crowd behind it. You will learn that trading is not about predicting whether the price will go up or down. It is about reacting appropriately to what is happening right now. The market has no obligation to move according to your wishes, but you can learn how to move with the market by staying flexible and following strict discipline. In a world where everyone wants more, faster, easier, Bob Volman's method reminds you that patience, consistency, and accepting small losses are the only real path to long-term survival in trading. If you are ready to give up complicated thinking and abandon the endless search for a non-existent holy grail, this method is for you. Learn to listen to the soft breaths of the market, the subtle contractions on the chart, and you will understand why thousands of seasoned traders deeply appreciate the value Bob Volman has brought to this craft. Bob Volman's trading philosophy. Bob Volman is known in the trading world not for grand theories or complex strategies, but for a sharp, realistic, and highly disciplined approach centered entirely on price action. His methods are not for those seeking shortcuts or systems promising overnight success. Instead, his philosophy is built on a simple yet powerful belief: every piece of information a trader needs is already present in the price chart. There is no need to add indicators, overlays, or external filters to complicate what is inherently clear to those who know how to read the market properly. At the heart of Bob Volman's method is a deep respect for the raw movement of price. Price itself is the purest reflection of market psychology: supply and demand, fear and greed, commitment and hesitation. He focuses entirely on what is happening right now, in real time, on the chart. This is not theory. This is not prediction. This is observation and response, moment by moment, with absolute discipline. Volman's work emphasizes a few foundational principles that shape his entire approach to trading. These principles are simple to understand, but difficult to master. They require consistency, patience, and humility from any trader who hopes to apply them successfully. The first principle is clarity. The cleaner the chart, the better. Cluttering a chart with multiple indicators, oscillators, or predictive tools only serves to distract the trader from what truly matters. Price action tells its own story. Every candlestick, every push, every pullback reflects the collective decisions of thousands of market participants at that specific moment in time. Volman teaches traders to strip their charts down to the essentials. He uses nothing more than a simple candlestick chart, often based on tick data rather than time frames, and a single exponential moving average to assist with identifying directional bias. Beyond this, he believes less is more. The second principle is language. Price action is the only language worth learning. Just as one cannot master a foreign country without learning its language, one cannot master the markets without understanding how price communicates. Volman does not rely on traditional chart patterns as taught in textbooks. He is not looking for head and shoulders or triangles. Instead, he reads price on a microstructural level, focusing on how price behaves at key moments. Areas of balance, pauses, consolidations, breakouts, and fakeouts. These are the words and sentences in the language of price. His trading setups often revolve around these moments of decision where the market shows its hand. The third principle is mindset. Trading must be approached through the lens of probability, never certainty. No setup, no matter how clean or how familiar, offers a guaranteed outcome. Volman is explicit in this regard. Success in trading does not come from trying to predict the market's next move. It comes from managing risk, executing consistently, and allowing probabilities to play out over a large enough sample size. Losses are part of the game. Small, controlled losses are the cost of doing business. Attempting to avoid them entirely is a path that leads only to frustration and failure. Volman's method does not seek to catch every move or predict turning points in advance. Instead, he teaches traders to wait patiently for the market to reveal moments of imbalance or clarity. These are typically expressed through clean structures, such as breakouts from tight consolidation zones, pullbacks that fail to reverse a dominant trend, or false breaks designed to trap weak hands. These moments, when read correctly, offer windows of opportunity where the odds can lean in the trader's favor. But even then, the emphasis remains on proper execution, not prediction. This philosophy is especially relevant in today's markets, where noise is everywhere. Modern traders are bombarded with information, from news headlines to social media to a constant flow of opinions and forecasts. Bob Volman's approach cuts through this clutter with a disciplined focus on the only thing that truly matters: price behavior on the chart in front of you. He advocates for working with short-term tick charts, not because they offer any magic edge, but because they allow the trader to see the micro behavior of price more clearly. Watching price unfold tick by tick reveals the underlying battle between buyers and sellers in a way that time-based charts often obscure. This helps the trader stay connected to the rhythm and pace of the market, making decisions based on flow rather than arbitrary time intervals. Risk management is central to Volman's philosophy. Stop losses are not optional. They are placed with precision, typically just beyond the point where the trade thesis is invalidated. This is not about giving the market room. It is about defining the point of failure and respecting it without question. Targets are determined by structure, not hope. Some trades will offer quick, clean exits with favorable reward to risk ratios. Others will require patience and the ability to sit through minor pullbacks without emotion. But every trade, win or lose, is part of a larger statistical game. The goal is consistency over time, not perfection on any single trade. Another key aspect of Volman's philosophy is neutrality. Traders must learn to approach each session with a neutral mindset. Attachment to recent outcomes, whether positive or negative, is dangerous. Yesterday's win does not guarantee today's success. Yesterday's loss does not demand revenge. Every day, every chart, every trade must be viewed independently, judged solely on the merits of the price action at hand. Emotional discipline is as important as technical skill. For those who adopt this philosophy, trading becomes less about chasing the market and more about letting the market come to them. Patience becomes the greatest edge. Waiting for clean setups, waiting for price to confirm, waiting for the right alignment of factors. This waiting is not passive. It is active observation, readiness to strike when the moment arrives and the conditions are right. Volman's method is not glamorous. It does not promise fast money or endless excitement. It requires work, study, and a willingness to accept the slow grind of learning through repetition. It is a method built for those who respect the markets, who understand the limits of control, and who value survival over ego. In the end, Bob Volman's trading philosophy is a call to simplicity, discipline, and respect for the reality of markets. It reminds traders that success is not about being right. It is about managing risk, recognizing opportunity, and executing with consistency. Those who embrace these principles will find a path not only to profitability, but to the professional mindset required to sustain it. 2. Tools and timeframes in Bob Volman's method. Simplicity is not just a preference, it is a strict necessity. His approach relies on a clean chart, minimal tools, and a sharp focus on the smallest details of price movement. Everything is designed to keep the trader connected to the raw price behavior, without distraction, without confusion. His tools serve only one purpose: to clarify the structure of price so the trader can make disciplined, well-informed decisions. The first and most critical choice in his toolkit is the use of tick charts rather than time-based charts. Specifically, Bob Volman works primarily with 70-tick and 200-tick charts. He does not use traditional 1-minute or 5-minute timeframes. This decision is rooted in how price reveals itself in real time. Time-based charts, by their nature, slice price into equal units of time, regardless of market activity. During slow periods, a 1-minute bar may contain almost no meaningful information. During fast markets, it may hide critical micro-movements within a single candle. Tick charts, on the other hand, advance only when a specific number of transactions have occurred. This creates a dynamic chart that speeds up during volatility and slows down during quiet periods, allowing the trader to see the market's rhythm as it truly unfolds. The 70-tick chart is Bob Volman's preferred canvas for scalping and short-term decision-making. It offers a tight, immediate view of price action, highlighting micro pullbacks, failed breakouts, and subtle shifts in sentiment that might be invisible on slower charts. The 200-tick chart, in contrast, serves to provide a broader context. It shows the larger structural trends, the bigger areas of consolidation, and the swing points that often define the market's boundaries for the session. Together, these two charts create a complete framework: the 70-tick for execution and precision, the 200-tick for structure and context. Beyond the chart type, Volman keeps his charts remarkably clean. His method uses Japanese candlesticks exclusively. There are no bars, no Renko, no Heikinashi, no alternative plotting methods. Candlesticks provide the clearest visual feedback on price behavior, capturing both movement and rejection in a single glance. The shape, size, and sequence of these candles tell the trader where momentum is building, where hesitation is creeping in, and where potential traps are being set. This is the raw language of price, and Bob Volman teaches traders to read it fluently. The only technical indicator present on his chart is a simple exponential moving average set to 20 periods. This EMA is not used for entry or exit signals. It is not a trigger, nor is it a prediction tool. Its sole function is directional bias. When price is trading above the 20-period EMA, the trader should favor long opportunities. When price is below, short setups take precedence. This moving average acts as a dynamic center of gravity, helping the trader stay aligned with the dominant flow rather than fighting it. This does not mean blindly following the EMA. Context remains king. The EMA serves to keep the trader grounded in the broader structure while still reacting to the micro movements within it. Price action in relation to this EMA often defines the nature of pullbacks and breakouts. Shallow pullbacks that respect the EMA suggest strength in the current trend. Deeper pulls or failures to reclaim the EMA warn of potential reversals or range-bound behavior. Beyond candlesticks in the EMA, Bob Volman emphasizes the importance of manually identifying key price areas on the chart. These are not drawn from automated tools or algorithms. They are observed and marked by the trader in real time. Areas of consolidation, previous swing highs and lows, tight ranges where price has repeatedly paused or reversed. These are the structures that shape market behavior. Volman teaches traders to recognize and respect these zones because they are where decisions are made, where liquidity gathers, and where traps are often set. The process of marking these zones is part of the trader's daily preparation. As the session unfolds, these levels provide reference points for judging price behavior. Is price respecting the upper bounds of a recent range? Is it breaking through with conviction? Is it pulling back to retest a breakout level? These questions guide trade decisions more reliably than any indicator ever could. By combining these simple tools, tick charts, candlesticks, a single EMA, and hand-drawn levels, Bob Volman creates a trading environment where focus is maximized and noise is minimized. This setup strips away anything that does not contribute directly to understanding price action. There are no stochastic oscillators, no MACD, no RSI, no Fibonacci retracements. None of these add value in his view because none of them can tell the trader anything the raw price is not already revealing. This minimalist approach demands more from the trader. It requires constant engagement, sharp observation, and the discipline to wait for clean opportunities. There are no shortcuts, no signals to follow blindly. Every decision must be rooted in a real-time reading of price behavior within the context of structure and flow. The simplicity of these tools is deceptive. While the setup appears basic, mastering it takes time and effort. The trader must learn to interpret the story told by each candle, each push and pull, each breakout attempt. The tick chart exposes every nuance of this story, leaving no room to hide. This is why patience is so critical. Trades are not forced, setups are not manufactured. The trader waits for the market to offer a clear imbalance, a moment where supply and demand tip visibly in one direction, creating an edge worth acting upon. In summary, Bob Volman's tools and timeframes reflect his broader trading philosophy: clarity over complexity, precision over prediction, observation over assumption. His method equips traders with just enough to read the market with accuracy, while demanding the mental discipline to apply that reading consistently. Success comes not from the tools themselves, but from how well the trader uses them to stay aligned with what the market is truly doing, not what they hope it will do. These principles may seem simple, but simplicity in trading is often the hardest discipline to achieve. Those who embrace this approach will find themselves trading with greater clarity, greater focus, and ultimately, greater consistency. 3. Bob Volman's trade setups. Bob Volman does not rely on traditional textbook patterns. He does not seek out head and shoulders, triangles, or any other predefined formations found in most technical analysis literature. His focus is entirely on real-time price behavior, reading the intentions of market participants through structure, flow, and the reactions occurring at critical price levels. The setups he identifies are rooted in pure price action and based on the observation of market rhythm, not static shapes or retrospective drawings. Volman's approach revolves around 4 core types of setups. These setups are straightforward in theory, but require refined skill in observation and execution. They demand a trader's full attention, patience, and understanding of how price moves through phases of balance, imbalance, and manipulation. These setups do not promise certainty. They offer opportunity, provided the trader applies discipline, structure, and sound risk management. The first setup is the pullback. A pullback occurs within a clear and established trend, either bullish or bearish. After the initial momentum wave, price typically pauses and retraces toward an area of balance where supply and demand briefly stabilize. This retracement is not random. It often serves to shake out weak hands, trigger stops, or encourage countertrend traders to enter prematurely. Volman advises watching these moments carefully through the behavior of individual candles. Look for small consolidations, sideways price action within tight ranges, and specific bars that show rejection or entrapment near the end of the pullback. This is not about predicting where price will reverse. It is about observing where sellers exhaust themselves in an uptrend or buyers give up in a downtrend. When confirmed, the pullback offers a tactical entry in the direction of the dominant trend with risk clearly defined by the structure itself. The second setup is the breakout retest. This setup revolves around areas of consolidation where price compresses within tight ranges, building energy for the next move. These areas act like coiled springs, storing potential as participants hesitate between continuation and reversal. Once price breaks decisively out of these zones, it often pulls back briefly to retest the breakout level. This retest is a moment of truth. If price holds above the breakout level in a bullish scenario or below it in a bearish case, it confirms that the breakout was genuine and not a trap. Volman teaches traders to observe the character of this pullback. Weak rejections, hesitant candles, and failed attempts to re-enter the broken range all provide valuable clues. Entries are taken in the direction of the breakout, with stops placed logically beneath or above the consolidation range. This setup capitalizes on the shift from uncertainty to conviction, aligning the trader with the flow of institutional money stepping in after the breakout. The third setup is the fake break. This is perhaps the most challenging to execute, but often delivers high reward relative to risk. It is not suited for novice traders or those lacking emotional discipline. A fake break occurs when price appears to break a key level, drawing in breakout traders and triggering stops, only to reverse sharply in the opposite direction. This move exploits market psychology, trapping those who chase confirmation too early and rewarding those patient enough to recognize the deception. Identifying fake breaks requires acute awareness of context. Look for exhausted momentum, lack of follow-through, and sudden rejection bars that invalidate the breakout. These setups frequently emerge around well-known support and resistance levels where retail traders cluster orders. Volman emphasizes the importance of not anticipating these moves, but reacting when the evidence becomes clear. Entries are taken after confirmation, with stops placed beyond the extremes of the false break. This setup leverages the market's tendency to punish impatience and reward discipline. The fourth setup is trend continuation. This builds directly on the foundation of reading pullbacks, but focuses specifically on how price interacts with the 20-period exponential moving average during an established trend. When price trends cleanly, it often pulls back to this dynamic level as part of its natural ebb and flow. These pullbacks to the moving average create opportunities for re-entry into the trend at favorable prices. Volman advises studying the reaction of price around this average. Small candles, indecision bars, failed attempts to breach the average, and rejections signal potential continuation. These signs must align with the broader structure of higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. Entries are placed when price confirms the resumption of the trend with stops logically positioned beyond the recent pullback. This setup benefits from aligning with the larger participants who consistently use moving averages as dynamic support or resistance in trending environments. Volman's methodology does not seek to outsmart the market, it seeks to align with it. These four setups are not secrets. They are reflections of how price moves through phases of accumulation, manipulation, and distribution. The skill lies in reading these phases without bias, without impatience, and without the need for predictive certainty. Each setup requires observation of context, structure, and the subtle shifts in price behavior that reveal the intentions of larger players. Pullbacks show the market's effort to test the strength of a trend. Breakout retests reveal whether the market is prepared to move beyond a previous boundary. Fake breaks expose where the crowd has been manipulated. Trend continuations offer chances to rejoin the dominant direction with favorable risk profiles. None of these setups work in isolation. They require the trader to read the broader picture, to understand whether the market is trending, ranging, or transitioning. They require discipline to avoid forcing trades and the patience to wait for clear confirmation. Bob Volman teaches that setups are only part of the equation. Execution, risk management, and mental clarity complete the picture. Traders must accept that not every pullback will lead to continuation, not every breakout retest will succeed, and not every fake break will produce reversal. Probabilities govern outcomes, not guarantees. Success lies in taking each trade when it meets the criteria, managing risk precisely, and allowing the statistical edge to reveal itself over time. This approach demands a professional mindset. It rejects gambling, guessing, and chasing. It embraces structure, process, and patience. Volman's trade setups reflect the reality of how markets function, stripped of hype and complexity. They offer traders a framework to engage with the market in a disciplined, logical, and repeatable manner. Those who master these principles position themselves not only for profitability, but for longevity in a profession where survival often proves more elusive than success. 4. Reading the market according to Bob Volman. Bob Volman's approach to reading the market is rooted in clarity, simplicity, and real-time observation of price behavior. He does not attempt to forecast the future or impose fixed patterns onto the market. Instead, he focuses on understanding the rhythm of price movement as it unfolds. His philosophy is built on recognizing how supply and demand interact on a tick-by-tick basis, and how crowd psychology reveals itself through price action. The first principle is structure. Price does not move randomly. It flows through phases of balance and imbalance, compression and expansion, hesitation and conviction. Volman teaches traders to read these structural shifts without relying on indicators or predictive tools. Areas where price consolidates reflect temporary agreement between buyers and sellers. These zones of balance are followed by movements where one side gains control, leading to directional moves. Recognizing these shifts helps the trader understand where the market stands within its cycle, whether it is accumulating, trending, or distributing. Volman's preferred charts, the 70-tick and 200-tick, allow him to see these microstructures clearly. The smaller chart reveals the immediate battle between buyers and sellers. The larger chart provides context for where these micro battles fit within the broader picture. Together, they form a complete view of market dynamics, free from the distortions of time-based charts. The second principle is flow. Price movement reflects the flow of orders, liquidity, and sentiment. Volman pays close attention to how price approaches key levels, how it reacts when tested, and how it behaves after a break. Clean, steady advances suggest strong participation. Choppy, hesitant moves signal indecision or manipulation. Watching these flows provides insight into who is in control, buyers or sellers, and whether they are likely to maintain that control. Reactions at specific levels are particularly important. Prior highs and lows, consolidation ranges, and breakout points often act as decision zones. Volman observes how price behaves at these points. Does it reject sharply? Does it linger, absorbing liquidity? Does it break and retest? These behaviors reveal the strength or weakness of the prevailing side and help the trader align with the path of least resistance. The third principle is pace. Markets have rhythm. Sometimes they move swiftly with conviction. Other times they drift aimlessly, inviting traps and fake moves. Volman advises traders to respect this rhythm. Fast, impulsive moves carry different implications than slow, grinding ones. Understanding the pace helps avoid trading during low probability conditions and positions the trader to capitalize when momentum aligns with structure and flow. Candle behavior offers valuable clues. Strong bodies with little wick indicate commitment. Indecision bars, pin bars, and failed attempts at continuation suggest hesitation or exhaustion. Sequences of candles tell a story about who is pressing, who is defending, and where the pressure may break. Volman reads these stories in real time, adjusting his expectations based on what price shows, not on what he hopes. The fourth principle is trap recognition. Markets often deceive. False breaks, failed follow-through, and sudden reversals are common tools used to shake out weak hands and mislead the majority. Volman excels at identifying these traps by observing price behavior at extremes. When a breakout fails to gain traction and reverses sharply, it often signals trapped traders forced to exit, fueling the reversal. Recognizing these moments allows the trader to position ahead of the inevitable correction, capitalizing on the pain of others without falling victim to it. Trap recognition ties closely to understanding crowd psychology. Retail traders often chase moves after they have already played out, buying highs and selling lows. Institutions create these traps to accumulate or distribute positions efficiently. Volman teaches traders to think like professionals, not like the herd. This means recognizing when price action invites participation only to punish it shortly after. The fifth principle is patience. Reading the market effectively requires waiting for clarity. Not every fluctuation offers opportunity. Many moves are noise, lacking the structure, flow, or conviction to warrant risk. Volman emphasizes standing aside during these periods. Patience is not passive. It is active observation, ready to engage when the market presents a clear imbalance and a favorable setup. Forcing trades during unclear conditions erodes confidence and capital. Volman's reading of the market rejects prediction. It embraces reaction. The market reveals itself through behavior, not through forecasts. By staying present, observing structure, flow, pace, traps, and waiting for alignment, the trader operates from a position of strength rather than hope. This disciplined approach aligns with professional trading practices, where risk is managed, decisions are based on evidence, and patience outweighs impatience. In essence, Bob Volman reads the market as a living organism, moving through cycles driven by human behavior and institutional mechanics. His method is not about mastering patterns. It is about mastering observation, understanding context, and reacting with discipline. This is how he maintains consistency in environments where randomness often tempts traders into mistakes. By focusing on what the market is doing right now, not what it might do later, Volman stays aligned with reality, giving himself the best chance to profit and survive over the long term. 5. Trade management, according to Bob Volman. Bob Volman approaches trade management with precision, discipline, and consistency. His philosophy is shaped by experience and rooted in the understanding that survival and long-term success in trading depend not on prediction, but on control. The way a trader manages the trade after entry often matters more than the entry itself. Proper trade management protects capital, preserves confidence, and positions the trader to benefit when probabilities align. The first principle is stop loss placement. Volman insists on always placing a stop loss beneath a clear structural level on the chart. This is not an arbitrary number of ticks or a fixed dollar amount. It is determined solely by price structure. The stop is placed at a point where the trade thesis becomes invalid. If price breaches this level, it signals that the setup has failed and the trade no longer offers the anticipated edge. This approach ensures that every loss is controlled, measured, and anticipated as part of the overall trading process. Tight stops are critical, but must be logical. Placing stops too close without structural justification leads to unnecessary exits. Placing them too wide dilutes risk to reward and undermines consistency. Volman's method requires the trader to read structure clearly, understand where supply or demand has been absorbed, and place stops accordingly. This discipline reduces emotional interference and removes the temptation to adjust stops irrationally. The second principle is target setting. Targets are defined based on the market's current volatility and structure, not on arbitrary expectations. Volman typically aims for reward to risk ratios of 2-to-1 or 3-to-1, depending on the opportunity presented. This means that potential reward is at least twice or 3 times the size of the risk taken on the trade. Targets are placed at logical points where price is likely to encounter opposition, such as previous highs or lows, significant ranges, or areas where liquidity may reverse the move. These targets are not moved without clear justification. Volman avoids the common mistake of cutting winners short out of fear or extending targets out of greed. The target is part of the initial plan and is respected unless the market provides new, strong evidence that warrants adjustment. This consistency ensures that the mathematical edge inherent in the strategy is preserved over the long run. The third principle is maintaining discipline with stops. Volman strictly warns against moving stop losses arbitrarily. Trailing stops are used sparingly and only when justified by fresh structure, not by emotion. Moving a stop to break even without reason often serves more to soothe the trader's fear than to protect capital effectively. Stops must serve the trade plan, not the trader's psychology. If price has not moved convincingly in the trade's favor, tightening the stop prematurely increases the likelihood of a meaningless exit. The fourth principle is avoiding position averaging. Volman is firmly against averaging into losing positions. He considers this a dangerous practice rooted in hope, not logic. Adding to a losing trade magnifies risk and often leads to larger losses. His method emphasizes accepting a loss quickly and cleanly when the trade invalidates. Capital is preserved by exiting losers, not by fighting them. The patience to wait for the next opportunity is far more valuable than the stubbornness to prove a losing trade right. Trade management, according to Bob Volman, is a reflection of his overall trading philosophy: clear rules, firm discipline, and respect for the market structure. Success is not about being right on every trade. It is about managing each trade professionally, keeping losses small, letting winners run to logical targets, and maintaining consistency through disciplined execution. This approach minimizes emotional decision-making and maximizes the trader's ability to stay aligned with the realities of the market rather than personal biases or fears. Volman's method serves as a reminder that great trading is not about brilliance or prediction. It is about process, patience, and precise management of every aspect of the trade, from entry to exit. Those who adopt this mindset position themselves for longevity and success in the challenging world of professional trading. 6. Mindset, according to Bob Volman. Bob Volman's philosophy on mindset is clear, direct, and uncompromising. He consistently emphasizes a single, powerful principle that shapes every part of his trading method: do not predict, react. For Volman, trading is not about trying to understand why the market is moving. It is not about guessing what will happen next or interpreting news headlines in search of justification. The market exists in the present moment. Price action reflects the collective decisions of all participants. It tells the truth of supply and demand better than any theory, opinion, or forecast. Volman teaches that the trader's sole responsibility is to read this behavior and respond with discipline, not prediction. This reactive mindset demands detachment from the need to know the reason behind every price move. The why does not matter. The what is everything. What is the market showing right now? Where is price consolidating, breaking, rejecting, or trapping? How are buyers and sellers interacting at key levels? These are the questions that guide decisions, not speculation about future events or unseen forces. Volman dismisses the importance of news entirely. Economic releases, political events, headlines, none of these shape his decisions. If news matters, it will already be reflected in price. Reacting to price allows the trader to remain neutral, focused, and aligned with reality. Chasing narratives or trading on opinions leads only to confusion and inconsistency. This mindset also reinforces patience. Not every moment in the market offers opportunity. Many moments are noise, traps, or indecision. Volman teaches traders to observe without attachment, to wait for clear setups, and to act only when price action confirms the imbalance necessary for a valid trade. Forcing trades out of boredom, fear of missing out, or the desire to predict is a recipe for failure. By focusing solely on reacting to the present market, Volman removes emotional bias from the process. There is no need for conviction about where the market must go. There is only observation, confirmation, and disciplined execution. This simplicity is powerful. It frees the trader from the mental burden of being right and refocuses attention on what matters most, managing risk and following the market's lead. In short, Bob Volman's mindset is professional, pragmatic, and built for survival. He understands that the market owes nothing to anyone. It rewards those who respect its reality and punishes those who try to impose their will upon it. His guiding principle remains constant. Do not predict, react. This is how professionals think, trade, and endure. 7. Bob Volman's entry process. Bob Volman approaches trade entries with precision, patience, and strict adherence to process. His method is not based on gut feeling or impulsive decisions. Every entry follows a clear and repeatable sequence rooted in reading price action objectively, understanding context, and waiting for the market to reveal an imbalance worth trading. The first step is identifying the environment. Volman begins by analyzing whether the market is trending, ranging, or transitioning. He observes structure on both his 70-tick and 200-tick charts to understand the bigger picture. Trending environments offer pullbacks and continuation opportunities. Ranges offer breakouts or rejection setups. Knowing the environment prevents forcing trades where conditions do not support them. The second step is narrowing focus to key price zones. These include prior swing highs and lows, consolidation areas, breakout points, and other levels where supply and demand previously clashed. Volman marks these areas manually, recognizing them as decision points where price often reacts decisively. These zones guide his attention, helping him anticipate where opportunities are most likely to develop. The third step is observing price behavior as it approaches these key zones. Volman watches for signs of exhaustion, the cap, rejection, acceptance, or aggression. This observation is granular, focusing on how individual candles form, how sequences of candles evolve, and whether price shows commitment or hesitation. Setups emerge through this behavior: pullbacks, breakouts, fake breaks, or trend continuations, not through arbitrary patterns, but through real-time evidence of supply and demand imbalance. The fourth step is confirming alignment. Before entering, Volman ensures the potential trade aligns with the broader context. Is price above or below the 20-period exponential moving average? Is the flow supporting continuation or suggesting reversal? Is the setup in sync with recent momentum or fighting it? This step prevents taking trades that conflict with the dominant structure, reducing the likelihood of forced or emotional decisions. The fifth step is preparing the trade. Volman defines the entry point clearly, often at the close of a confirming candle or after a specific price rejection. He places his stop loss beneath or above structural levels that, if broken, invalidate the setup. The target is set according to the expected range of movement, typically aiming for a reward-to-risk ratio of 2-to-1 or 3-to-1. Everything is defined before entry, leaving no room for hesitation or second-guessing during the trade. The sixth step is execution without hesitation. Once the criteria are met, Volman acts decisively. He does not negotiate with himself, wait for extra confirmation, or fear pulling the trigger. Discipline at the moment of entry separates professional trading from amateur guessing. Execution follows preparation, not emotion. The seventh and final step is management after entry. Volman monitors the trade according to his rules. He does not move stops irrationally. He does not chase larger targets without reason. He allows the market to play out, accepting that losses are part of the process and wins come from consistency, not hope. Management decisions are made only when price action provides clear new information, not in reaction to fear or greed. This entry process reflects Volman's overarching philosophy: structure, discipline, and alignment with real-time price behavior. He respects the market's authority, never imposing his will or expectations upon it. Success comes from reading, waiting, and reacting with precision. This is how professionals operate, and it is how Volman teaches traders to build consistency in a field where many fail for lack of process. 8. Common mistakes Bob Volman warns against. Bob Volman is clear and direct when it comes to warning traders about the most dangerous and costly mistakes. These mistakes are not unique to beginners. Even experienced traders can fall into these traps when discipline slips or when emotions cloud judgment. Volman's guidance is shaped by years of observation and practice, and his warnings are rooted in the realities of professional trading. The first mistake is prediction over reaction. Volman consistently emphasizes that trading is not about forecasting the future. Trying to guess where price will go based on opinion, hope, or bias leads to frustration and losses. Instead, traders must react to what price is showing in real time. The market tells its story through price action, structure, and flow. Traders succeed when they observe and respond, not when they try to predict. The second mistake is overtrading. Volman warns that trading too frequently is often driven by boredom, impatience, or the fear of missing out. Overtrading leads to poor setups, unnecessary risk, and emotional exhaustion. Professional trading requires patience. High-quality opportunities are rare. Waiting for the right conditions is a sign of strength, not weakness. Forcing trades will erode both confidence and capital. The third mistake is moving stops irrationally. Adjusting stop losses without valid structural reasons is one of the quickest ways to undermine a trading plan. Moving stops to break even too early, trailing stops emotionally, or widening stops in fear of a loss leads to inconsistent results. Volman teaches that stops should be placed logically and left untouched unless clear price action warrants a change. Stops serve the structure of the trade, not the trader's psychology. The fourth mistake is averaging into losers. Adding to a losing position is a temptation many traders face. It often stems from the refusal to accept a loss and the desire to force a trade to work. Volman strongly advises against this. Increasing risk on a failed trade compounds mistakes and often leads to catastrophic losses. Professional traders cut losses quickly and move on. There is no shame in a loss when it is controlled and part of a sound process. The fifth mistake is ignoring market structure. Trading in isolation from structure is like navigating without a map. Volman warns against taking trades that ignore the bigger picture. Entering against the dominant trend, chasing moves far from key levels, or trading inside noise leads to low probability outcomes. Structure guides the trader to where price is likely to react. Respecting structure increases consistency and reduces randomness. The sixth mistake is trading based on news or opinions. Volman disregards headlines, forecasts, and analyst predictions. Reacting to news is often a gamble because by the time information is public, price has usually adjusted. Opinions create bias, and bias blinds traders to what price is actually doing. Staying focused on price action keeps the trader aligned with reality, not speculation. The seventh mistake is emotional decision-making. Fear, greed, frustration, and overconfidence destroy trading performance. Volman teaches traders to follow process over emotion. Discipline means sticking to the plan, respecting stops, and accepting losses without hesitation. Emotional trading leads to revenge trades, over-leveraging, and inconsistency. Calm, measured actions protect both capital and confidence. The eighth mistake is neglecting patience. Impatience leads to premature entries, exits without reason, and abandoning plans at the worst moments. Volman emphasizes that patience is an active skill, not passive waiting. It is the discipline to observe, to wait for clean setups, and to act only when probability aligns. Successful trading is a waiting game more than a predicting game. Bob Volman's warnings are not theoretical. They reflect the realities of the market and the behaviors that separate professionals from amateurs. Avoiding these mistakes requires awareness, discipline, and a commitment to process over emotion. Consistency comes not from avoiding losses altogether, but from avoiding behaviors that magnify them unnecessarily. In the end, Volman's advice is simple but profound. Trade with structure, discipline, and clarity. React to price, manage risk professionally, and avoid the emotional pitfalls that ruin careers. This is how traders survive, thrive, and achieve longevity in a field where mistakes are both expensive and unforgiving. 9. Bob Volman's teaching style. Bob Volman's teaching style reflects the same qualities found in his trading philosophy: clarity, simplicity, and focus on real-world application. He does not dress up trading in unnecessary complexity, nor does he entertain the illusions of easy money or secret formulas. His approach is practical, methodical, and designed specifically for those who want to master the craft of trading price action at a professional level. The first characteristic of his teaching style is realism. Volman makes it clear that trading is hard. It requires patience, discipline, and years of deliberate practice. He rejects the idea of shortcuts. His material does not cater to the get-rich-quick mindset. Instead, he focuses on developing the trader's ability to read price action through consistent repetition, observation, and learning from mistakes. He sets honest expectations. Trading is a skill, not a game, and mastering it is a long-term commitment. The second characteristic is precision. Volman's writing and teaching leave no room for ambiguity. He explains concepts in exact terms using detailed examples and clear illustrations. Every chart, every scenario, and every explanation serves a single purpose: to help the trader understand how price action reflects crowd psychology and supply and demand imbalances. He does not use vague language or broad generalizations. He breaks down complex ideas into simple, actionable steps. The third characteristic is structure. Volman teaches through a systematic progression. His lessons build upon each other, moving from basic principles of price movement to more advanced reading of market flow, structure, and traps. This structured approach helps traders develop a solid foundation before attempting to apply more nuanced strategies. He emphasizes understanding before execution, patience before action, and observation before decision. The fourth characteristic is focus on the live market. Volman trains traders to work with real-time information, not hindsight analysis. He stresses the importance of learning to read live price action as it unfolds, recognizing patterns of behavior, and responding without hesitation. Backtesting and theory have value, but real skill comes from developing the ability to interpret unfolding price behavior in the present moment. The fifth characteristic is discipline. Volman instills a mindset of discipline through his teachings. He reinforces the necessity of following rules, managing risk strictly, and respecting the market's structure. His material does not indulge in fantasy or hypothetical scenarios. It is rooted in the realities of professional trading, where discipline is the cornerstone of survival. The sixth characteristic is honesty. Volman does not promise success. He does not guarantee profits. Instead, he teaches the principles that increase the probability of success when applied consistently and correctly. He is transparent about the challenges traders face: emotional control, psychological endurance, and the grind of day-to-day execution. His honesty builds trust with serious students who appreciate straightforward guidance over empty marketing. The seventh characteristic is focus on essentials. Volman avoids overwhelming traders with excessive tools or strategies. He believes in mastering the core elements of price action: structure, flow, pace traps, and reactions. His teaching strips trading down to its essentials, removing noise and distractions. This minimalist approach helps traders concentrate on what truly matters. The eighth characteristic is repetition. Volman emphasizes the value of repetition in developing skill. Reviewing charts, replaying scenarios, and observing how price behaves at key moments reinforces understanding. Through repetition, traders build familiarity, sharpen intuition, and cultivate the patience required for consistent execution. In summary, Bob Volman's teaching style is professional, practical, and focused on developing real skill. He guides traders through a structured process that demands patience, discipline, and a willingness to embrace the realities of the market. His methods are built not on promises, but on principles, aimed at preparing traders for the challenges of working with live markets through a clear, systematic, and honest approach. 10. Brief summary of Bob Volman's style. Bob Volman's style is defined by clarity, simplicity, and professionalism. He focuses solely on pure price action without the use of indicators, news, or predictions. His method relies on reading structure, flow, and pace through clean tick charts and observing how price behaves in real time at key levels. His philosophy is grounded in reaction over prediction. He teaches traders to wait patiently for the market to reveal clear imbalances through patterns of behavior, not to chase trades or guess future moves. Volman emphasizes strict discipline in stop placement, trade management, and patience. He avoids emotional decisions, averaging down, or moving stops without structural reasons. His style is suited for serious traders who seek consistency through a minimalist and methodical approach. He values process over outcome, precision over speed, and clarity over complexity. In essence, Bob Volman trades and teaches with the mindset of a professional. Focus on price, respect structure, act only when evidence is clear, and manage risk without compromise. 11. Bob Volman's message to traders. Bob Volman's core message to traders is simple, timeless, and deeply professional. Trading is not about prediction. It is about reaction, discipline, and survival. The market rewards those who respect its nature, follow its structure, and protect their capital. It punishes those who chase, hope, or ignore reality. He reminds traders that consistency does not come from brilliance or luck, but from mastering the basics. Reading price action with clarity, managing trades with discipline, and executing with patience. Volatility, noise, and uncertainty are part of the game. Your edge is not in forecasting, but in reacting with precision to what price shows you now, not what you think it should do. His final words often echo this belief. Control what you can, your entries, your stops, your mindset. Let go of what you cannot, the outcome of any single trade. If you are serious about mastering the mental game of trading and want to build a foundation based on discipline, structure, and real-world principles, subscribe to Trading Mindset Lab today. Join a community where professional thinking is not an option. It is the standard.